Welcome back. This is Module 7B, the wonderful world of taxes. Not exactly a thrilling topic, but one of significant importance to every business, be it a small business, a new business, or of course large businesses. But we're going to focus here on the new venture and how taxes impact that business. We're going to look at the different types of taxes, payroll taxes, employees versus independent contractors, and the other topics listed here. You're getting tired of seeing this chart, I'm sure, but again, remember the differences in the business formation between a sole proprietor, a partnership, a limited liability company, which is very popular, and we're going to explain in this module the difference between a C Corp and an S Corp. Again, you've seen this before. We're going to be dealing with dividends and shares of stock, and this is how you figure out the ownership of the business. It's a number of shares that you have over the total number of shares that in the company. And it's a percentage. And again, at least in a corporation, you divide the profits based upon ownership. Limited liability companies have some extra flexibility in determining that profit breakdown, but again, most of the times you share the profits based upon your percentage ownership. Well, the old saying is there are only two things that are certain, death and taxes. And we're going to talk about taxes. When you start your business, you have to register. Again, back in the legal piece about setting up the company, I talked about getting a federal ID, or an FEIN, Federal Employer Identification Number, or tax ID. The form that's used for that is an SS4, but even that form is now online, and you can do it over the internet and get it. It's free. It's the company's equivalent of a Social Security number. New Jersey, you have to register with not only with the feds, with the Internal Revenue Service, but you have to register with the state of New Jersey, and they use this federal ID. However, if you are in a business that is involved with sales tax, collecting sales tax as part of your business process, you have to have a separate sales tax number from the state of New Jersey. All right, and you use that to pay the sales taxes that you've collected from your customers and consumers. Well, here's the different kinds of taxes. Both the feds, the IRS, and the states, most states, New Jersey has an income tax, Pennsylvania, New York. Some states do not have individual income taxes. They have, but many of them do have corporate income taxes. So you have to look at each state individually. For purposes of this course, I'm going to focus on New Jersey. Again, if somebody has specific questions about other states, you're welcome to email me, and I would be happy to research that for you and give you some ideas. Now we've got payroll taxes, and I said sales taxes, and we'll talk about if you're buying for resale. Okay, payroll taxes are the first thing we should look at. As an employee, if you work for a living, as I'm sure many of you do, you get a paycheck, hopefully. But if you get paid $300 a week, let's say, or $500 a week, whatever. You don't get that amount of money in your pocket. You don't get that amount as your net check. Things get deducted from it. Much of it is taxes. And from the employee's piece, the company has to deduct federal income tax, Social Security, Medicare, state income tax, and state unemployment insurance and state disability insurance. And that's typical in most states, and certainly is here done in New Jersey. What is sometimes overlooked is the employer's portion of these taxes, namely Social Security, Medicare, and unemployment and disability. The employer has to pay a percentage of the payroll for those taxes. It is 15%, 15% of the payroll. So when you're doing your spreadsheets for the business, you'll see payroll taxes. That's the employer's portion. So if you have $1,000 a week payroll, you have to up it by 15%, which is $150, because that's what you have to pay to the IRS and the state. When an employee comes to work for you, they fill out a W-4 form, and you've probably done that, that says how many exemptions you want taken out for tax purposes, whether it's just you, you and 2 kids, you and a spouse, so forth. Now, it's important to realize that these payroll taxes are trust funds. When you take the money out of your employee's paycheck, and again, I think I said as a rule of thumb, figure 30%, but let's say it's 25%. So let's say you get paid $400 a week, or the employee gets paid $400 a week. You take $100 out of that $400 and tuck it aside and give the employee the $300 net paycheck. That's not your money. That belongs to either the employee or the Internal Revenue Service or the state of New Jersey. It is not your money, even though it's still sitting in your bank account. But what happens? Well, you need supplies, you have bills to pay, you need more inventory. The stuff that you produced and sold hasn't been paid for yet. It's still in accounts receivable, waiting for the customer to pay. You need cash. You need money, and you've got perhaps a couple of thousand dollars sitting in the bank account that really are these withheld payroll taxes. But what do companies do? What do small business people do? They say, well, you know what? I'm going to borrow that money from the account. And when the checks come in next week from the customers who owe us money, I'll pay it back. And nobody will know the difference. And what happens next week? The checks don't come in. And now you're in trouble. It's basically theft. And a very high percentage of small businesses that go out of business have that problem or are forced to close up because they have misused these trust funds. And the IRS and the state of New Jersey has absolutely no mercy. All right? And you, as an officer of the company, as the manager of the company, as the person responsible, can have some really serious liability, criminal liability, for misusing this stuff. So don't do it. And it's easy to say, but People do it, but again, can get yourself in a lot of trouble. Well, we mentioned employees. There are basically two ways to work with people or have people work for you. You can have them as an employee of your company, which means they work for the company. You pay them regularly, you deduct their taxes, you pay your share of the 15% that I mentioned, give them benefits. At the end of the year, you give the employee a W-2, and those of you who work for companies probably get a W-2 at the end of the year for purposes of filing your taxes. However, in some businesses, it makes more sense to use independent contractors, where you get paid for the job done. I need you to update my website. I pay you $1,000 to update my website. You don't really work for me. It's just a task, arm's length relationship. I don't deduct the payroll taxes. I don't give you any benefits. At the end of the year, if I've paid you more than $600 in the calendar year, I give you a 1099 and send a copy to the IRS in the state. Well, the trick is, one of the advantages to the employer, the boss, is that you don't pay benefits, and I, as the employer, don't pay that 15% of the payroll tax. Well, guess what? It doesn't go away. The independent contractor has to pay that as self-employment tax. So if you are working for somebody or working with somebody as an independent contractor, and they're not deducting any taxes and they're going to pay you on a 1099, be aware that you will owe an extra 15% on income tax and Social Security, both to the state and the feds, as self-employment tax. So you better make sure your rates are high enough to compensate for that, otherwise you're not going to make the money you thought you're going to make. Well, who's an independent contractor as opposed to an employee? The IRS has made some serious, put some serious controls over this. The way it came about is that, again, the IRS would prefer to see a person as an employee because the money gets deducted directly out of their paycheck. The company has the responsibility of giving it to the IRS. The company has to pay the 15%, as opposed to the IRS having to depend upon the individual to claim it and pay it. The government also likes to see benefits, health insurance, hospitalization, medical, that kind of thing. So they're in favor of an employer-employee relationship. However, it started with companies like AT&T. What they did is they had layoffs. And they got rid of these employees, and then they brought them back as independent contractors. Didn't give them any benefits, didn't take any money out of their paychecks, paid them via 1099s. The IRS didn't like it because these people were doing the exact same job that they were doing before. But now they weren't employees, they were independent contractors. The IRS said, hey, if you, the company, the employer, controls where the job is done, when it's done, and how it's performed, that person's an employee. If you have designated that person by name as opposed to just outsourcing it to some contractor who may have one or more people working on it, if this thing has to be done by a particular individual by name, they're an employee. If you pay them every week as opposed to at the completion of a job, they're an employee. If you the employer, give them the tools and materials to work with, they're an employee. And if that person works strictly for you, as opposed to selling their services to somebody else, they're an employee. Well, they kind of nailed AT&T on that, and later on, Microsoft got in trouble in a similar fashion because of this using independent contractors, and the people banded together and brought suits saying, hey, wait a minute, we're doing exactly the same job as independent contractors as the employees are, but we don't get benefits. So again, the government looks very hard to see whether these person or persons are employees, and if they are considered to be employees, then you as the employer have to deal with them, pay the payroll taxes, and provide benefits. Now, independent contractors are prevalent in a lot of areas. Again, a web service provider, somebody who updates my website or something like that. Dance studios, dance teachers, ballroom dance teachers, things like that. Typically rent space. They are frequently not employees. They just pay for use of the studio, use of the dance floor with their particular clientele. Used to be hairdressers would rent a chair at a salon, again, not be an employee, but the state of New Jersey has made that illegal, again, for the reasons we just talked about. So, again, you have to know something about the kind of industry that you're in, and whether they are strictly employees or whether they deal with independent contractors, how that's worked. All right. Let's take a look at something that perhaps we shouldn't talk about, but it is important. In many businesses, companies, employers hire illegals, and we talked about that in the operating issues portion of the legal piece back in week 5. You have a legal obligation to make sure that the person has the equivalent, what used to be called a green card, so they can work here. But that's not reality, and you see the day workers on various street corners in different towns, and they are a very important part of the economy, be it even though an underground economy. Well, here's a scenario, okay, of using an employee and what it costs. If you use an independent contractor, you pay that person a little bit more because they have to pay the self-employment tax, right? I said make sure you up your rate by enough to cover that extra 15%. So the independent contractor, if they're smart, is going to charge $100 for the day or for the hour or whatever the increment is. You as the employer don't pay any taxes. Your expense on the books. And it comes out to the same thing. You pay it one way or the other. But what if we, hire some day worker off the street? We can't show it on the books. I mean, that's asking for trouble if somebody comes in and does an audit. Okay? But it doesn't reduce our profits. But we pay that person because they're an illegal. We pay them substandard wages. And unfortunately, the people who do this, the day laborers and that, are forced to work for these substandard wages. So that even though we can't put it on the books, even though it doesn't reduce our taxes in any way, it's strictly cash, cash out of pocket, it costs us less. The downside is that if it is found out, if they catch you doing it, you're going to have to pay the employee tax on the fair wages that you should have paid that person. You're going to have to pay the employer tax, and you are going to get nailed. So, is it worth it? I don't think so, but You know, there are lots and lots of businesses out there, particularly in the construction industry, that work that way. Here's a cheat sheet for tax choices. Sole proprietor, partnership, again, we've been there. The S corporation. Okay, the idea of an S corp is just a tax election. You have to elect it within 75 days of the start of the tax period, or start of the company, first off. And when you make that S corporation, you are taxed as if you are either a sole proprietor or a partnership, depending upon whether there's one owner or more than one owner. That means it flows through to your personal tax returns. All right? The LLC has, a lot of flexibility, as you can see. Come back and revisit that in a second. First, before that, I'd like to talk to you about a little bit about the myth of double taxation, and this slide did not come out the way it should because it's turned in landscape version. There is a separate on Moodle. There is a separate PDF file called Double Taxation, and it consists of the PD Acrobat version of 2 slides printed long ways, so that you can actually see the slide the way it should be. So I ask you to please open up that slide that file so that you can see it. Well, this looks like our standard income and expense statement. Revenue, cost of goods sold. Difference is the gross margin. Deduct your overhead expenses, and you get a net profit before tax of $20, $20,000, whatever dimensions you want to put on it. If we're an S corp, the profits flow directly through to the owner, to the owner's personal tax return. Okay, goes on a schedule, and it becomes part of that person's income tax. Well, okay. So suppose your personal tax rate is 6%, and or $6 on the 20% profit, on the $20 profit, let's say. So you pocket a net of 14. If you decide not to be an S corp, you pay 20% tax on the profit, so that's 4, which brings out 16. Now that's $16 or thousands goes out as dividends to the owner. Mentioned that word before, dividends. The owners, the stockholders, have to pay personal tax on those dividends, so they wind up with a net after tax of 11, a loss of $3. Doesn't make much sense. That's the problem with double taxation. It gets taxed at the corporate level, and then when it goes out to the owners as dividends, it gets taxed again. However, that's not always a problem. Let's take same scenario, but now our overhead expenses, what we've done is we decided to have a corporate meeting, an annual strategy session, a thank you party, a strategic retreat, where I don't know, Bermuda's nice, Hawaii's nice, the Bahamas, even Atlantic City. Why not? Corporate meeting as an expense. Maybe you do a lot of driving. Your key employees, key executives need a company car, company limousine, something like that, or at least a company car for a small business. Business expenses that go into the overhead. Again, the slide is a little mixed up from the formatting, but take a look at it on the PDF file. Now we wind up, because we've had more expenses, we wind up with a net profit before tax of 10. If we had elected to be an S Corp, we could not deduct that corporate meeting or company car. No personal benefits. It flows right through. But as a C Corp, we can use it. Again, we pay our 20%, which is 2, which means we have 8 going out to the owners who pay personal tax and wind up with a net after tax of $6 plus the 10 in benefits. That's 7 and 3 from above. The company car, the nice corporate financed vacation. It makes sense. You can do lots of things as business expenses to reduce that tax, but you can only take advantage of many of those things if you're a C corporation, not if you're taxed as an S. Well, that works if the owner of the company, if the stockholder or stockholders of the company are the same people as the managers and the officers. Because whether it comes in one pocket or the other pocket doesn't make a whole lot of difference. Where it does not work is if the management of the company and the stockholders of the company are different. If you're a stockholder of AT&T or Pfizer or General Motors, are you particularly, and you're just an individual and you have bought stock in one of these companies, are you interested in giving more perks, more benefits, more golden parachutes to the executives? Absolutely not. They get enough already. So you would rather see the prior scenario on the slide and get those dividends in your pocket because it's more to you. It can also be a problem if you bring in outsiders, if you bring in venture capitalists, angel investors that we're going to talk about next week, somebody who is not an insider in the company, but somebody who instead has just invested money and is looking for a return or profit on that investment, which is dividends. So again, that if you go outside to get money to run your business and give away a piece of the business in form of equity, those new investors may severely limit some of the games that you can play, such as company cars and perks and maybe a corporate airplane, or if you're rich enough, something like that. So again, there are pluses and minuses to everything. I just talked about, are the owners the same people as the managers? If yes, you can do all kinds of things. You have choices. This is, again, summary. One of the interesting scenarios is that an LLC or a corporation can have retained earnings, but it has to be taxed as a corporation. Retained earnings are money monies that are not paid out as dividends to the owners, but rather held by the company for expansion purposes, for research and development, to fund new products and research on new techniques. And it's very important to R&D. But again, you can only have retained earnings if you're taxed as a corporation. As a practical matter, one of the reasons why you would elect to become an S corporation, and I believe I mentioned this again back in the legal, someplace in the legal piece, is that the federal government and the states subsidize you if you are starting a new business, in the sense if you have losses. Again, the possible scenario is you have a day job, you make $40,000 a year in income, you've started a new business, your new business loses money the first year because of your marketing expenses, your startup, inventory, all kinds of things. So you lose 10 grand the first year on your new business. By being an S corp, you can flow it through an S corp or an LLC, taxed as an S corp or a partnership. You can flow that through to your tax return, and that $10,000 loss becomes a minus number to be deducted from your personal income. So that instead of paying tax on 40 grand, you pay tax on 30. It's a help. Okay? The limit, and I think, again, I mentioned this in the class, perhaps I didn't earlier in the class, but the IRS typically looks at 3 years, and they tend to take the position that if you don't make a profit within 3 years of starting your business, they consider it a hobby, and hobbies are not tax deductible. So the trick is you want to show some sort of profit, even if it's very minimal in the third year. The fourth year you may go negative again, but you should make a profit every once in a while so that they don't try and say, hey, you're not in this thing seriously, you're just doing this as a hobby. Now, if you don't have a day job and all you have are losses, you don't want to elect to be taxed as an S corp. You would rather be taxed as a C corp, whether you're an LLC or a corporation. Why? Because you can carry forward those losses to future years. Again, there are limits on it, but they're pretty good. So, and sometimes you have to make that decision. We've had that situation. Now, it'd be really nice if your company's making a profit rather than a loss. I mean, that's the objective of going into business. You have to look at your own personal tax bracket versus the corporate tax. If your personal tax bracket, if you're making a lot of money from your day job, is higher than 20%, again, you do not want to be taxed as an S corp or sole proprietor partnership. You don't want it flowing through to your personal tax return. It would be better to pay the corporate tax return, keep some retained earnings in the corporation for expansion and new equipment, and just take out the dividends that you really need, and you'll pay taxes at your own personal bracket. If, on the other hand, your incremental tax bracket is lower than 20%, then it's better to be taxed as a partnership or S corp, and have it flow through to the owner's personal tax returns. I talked about this back in the myth of double taxation. If we want to avoid taxes on dividends, you can do that by giving a salary to the uh, employees, to the owners. The owners can take a salary, all right, that doesn't get taxed at a dividend rate. You can give them bonuses, the benefits, the company meeting that I talked about, and the company car, that kind of thing. But again, it only works if the owners and the managers are the same. If it's not a public company or getting money from venture capitalists or business angels, investors. Another possibility is a stockholder loan. It is, instead of giving a person, an owner, a stock, in other words, typically if I were to invest in your company, you and I was to join your company, I would say put up $50,000, and in return, perhaps you would give me 10% of the stock or 20% of the stock, representing my 10 or 20% ownership of the company. Well, of course, then my share of the profits get taxed as dividends. A way around that is a stockholder loan. Maybe that $50,000 that I put up, assuming I already own a little piece of the company and we need an extra $50,000, and I say, look, I'll put that up, but instead of getting more stock, I lend it to the company, all right, as a loan. Well, now when the company pays me back, the repayment is a company expense, but it is not taxable back to me, the stockholder. I don't have to pay taxes because it's not dividends. Now, if I'm making interest, and of course I would probably get some interest on this thing, I would have to pay income tax on the interest portion of it, but not on the principal. So that's a way to enable the company to get more funds, again, if the current owners are capable of putting it up. Again, the scenario being that we're existing owners and I want to put, or I am willing to put more money in there, but I don't particularly want to pay higher dividends because of my tax rate. So there are ways of doing it. Get a good accountant. Get a good small business accountant. Here's tax returns. Again, everybody should, I would hope that many of you, if not all of you, have filed a tax return sometime in your life. Form 1040. There are schedules with a sole proprietor or an S corp or a partnership. They are schedules that attach to the 1040. The actual partnership return or S corporation return doesn't pay tax. All it gives is the name, address, and social security number of all of the owners involved in either the partnership or the S corp, and that gives the IRS a way to cross-link, as it were, or relate back to the individual tax returns of those people, the 1040s that those people filed to make sure they claimed it. On the other hand, a corporation, C corporation does pay. We talked about that. They file a tax return and pay on it. The LLC can be taxed either way. And lastly, here's the website. There, all of the information and instructions are out there on the web. Excuse me. Finally, we come to sales taxes, and here I talk about just in New Jersey, although their sales tax is prevalent around the country, 142 different jurisdictions. Even within New Jersey, we have a crazy quilt of taxes. There are areas that pay 7% taxes. There are certain portions of certain towns and cities that are in these economic development zones, I believe they're called. Go by different names, but where you pay 3.5% tax. again, to help stimulate business in those areas. What is taxed, what is not taxed, varies from state to state. Depends on what lobbyists were leaning on what politicians at the time it was passed. In New Jersey, clothing is not taxed. In New York, clothing is taxed. Again, no rhyme or reason. You have to know something about your industry. There are on the state of New Jersey website, there are lists that tell you what is taxed and what is not taxed. The government would dearly love to tax mail order and web sales and charge sales tax on it. The state governments have not been able to do that. It's been struck down a number of times. If you do pay sales tax on a web order or a mail order, and you'll see at the bottom of the order form, residents of Pennsylvania, California, and New Jersey, pay this tax. Or, if you're a resident of Pennsylvania, you pay this percentage. If you're a resident of California, you pay that percentage. Well, why does that happen? Answer: because the company has a bricks and mortar presence in that particular state. And the states have been able to charge sales tax, even though the stuff wasn't bought in that state, even though both the customer is there, the web server is outside the state. If the company has a sales office, a factory, a warehouse, a distribution center within its state, that state has the right to collect sales tax. So that's why you'll see, depending upon the company, that certain states can collect sales tax, and they have to collect sales tax on it, that they have some sort of bricks and mortar. Larger companies that have offices or salespeople or some sort of physical presence in every state, they charge the state sales tax. Companies like Lenovo, even though you buy your Lenovo laptop through the web, you wind up paying tax. Sales tax exemption, buying for resale, it's a form called an ST3. You apply to the state. In this case, in the state of New Jersey, it's called an ST3, and they give you a sales tax number, and you have to file your monthly return, else quarterly. If you file monthly, if it's over $500, and if you're buying for resale, if you're selling it to somebody else, like materials that you can use and build into your product or use or sell to a customer, you don't pay sales tax, because you will be charging sales tax to the ultimate user, and sales tax is only charged once. So if you're in the construction business and you have to buy replacement windows to be put in, or electrical boxes to be put in, or stuff like that, you can use your resale certificate so that the people you buy it from don't charge you sales tax, but then you're obligated to pay or charge sales tax to the consumer. Now, this can cause headaches as a practical matter for, again, the small business scenarios in a restaurant. I know a number of restaurateurs who go to places like BJ's and Costco's to buy some of their stuff. The food products that they use to make the food that they sell to the people who come to the restaurant and are used in there, many of those items, if they are being used in the product for resale, are tax exempt. Now, most food products are not charged, you don't pay sales tax on, but certain items that go into the cooking. However, on the other hand, if it is something that is strictly used in the business and not resold, like cleaning materials, paper towels, detergent and that kind of stuff, you do pay sales tax. In the construction business, you would not pay sales tax. You would on windows that you would install for at a person's house if you were building an addition or doing some renovation. On the other hand, if you buy a hammer or screwdriver, you're going to pay sales tax on it because it doesn't get resold. And lastly, there is a thing called a use tax in many states, such as New Jersey. In theory, if you buy something out of state and you bring it in here, and it would be taxable under New Jersey law, you are supposed to file a use tax return and pay the equivalent of the sales tax to the state of New Jersey as if you had bought it here. Do people do it? Absolutely not. Okay? It's the least effective tax that the state has ever seen. They try every once in a while to enforce it against certain industries, certain types of businesses, but usually it doesn't work. Well, we've come to the end of this module. Next week, we will be looking at venture capital, risk capital through business angels. They are both kinds of equity funding where people invest in the business and own a piece of the business. We will also take a look at launching the business and getting it started and what it takes to get it off the ground, as it were. Make sure you read the supplemental reading that I mentioned about the People's Bank, and there's also some read for next week about launching the new business. So make sure, and of course, read the chapters assigned from the text.